Hello there, folks. It's Roger from There Be Giants, and welcome back to another episode of Giant Talk. And today we continue our tradition of having really interesting guests, because we've got with us James Church, who happens to be the founder and chief operating officer of Robot Mascot. James, welcome to Giant Talk.
Thanks for having me. Thrilled to be here.
No, it's great to have you. Great to have you. So can we just kind of dive in with just kind of introducing yourself to the listeners, a bit about you, a bit about what's got you to where you are now?
Yeah, absolutely. So, I'm James Church. As you said, I'm the author of a best-selling book, Investable Entrepreneur, and co-founder of Robot Mascot. So we're an investment readiness agency. We help people raise investment and get funding. But we started life as a brand agency. So my background and my co-founder's background is in brand communication. And we started life about a decade ago now as a branding agency. And we really wanted to work with pioneers, exciting individuals that were doing interesting things, breaking the status quo. And that led us to working with startups and those that were sort of seeking funding. And over time, that kind of led to us, to cut a long story short, over a period of years, sort of focused our skills in brand communication to understanding investor communications and created a real niche and a focus on understanding how to sell your shares to investors. So we were great at communicating products and how to sell your products to your audience. And we figured out that raising investment is just selling your shares to an investor. And it's the same thing. The product becomes the shares and the customer becomes the investor. And we created a formula and approach, used all of our skills in brand and communication and advertising to develop a formula that helped founders better articulate their message to investors, avoid that zombie stare of kind of when you pitch your idea and you just get that blank glazed over look. And that was really the start of it. So we really evolved and sort of pivoted. It's that classic kind of pivot once you find that niche.
It's great to, there are plenty of branding agencies, there are plenty of communication agencies out there, but finding your, like you say, your niche, your hat, your hook to hang your hat on it makes a difference, because that's when you really cut through, isn't it?
Yeah, absolutely. It can be scary to niche, because especially when you start out, right? Because you just want the money through the door so you can pay the bills, and you end up, when we started, we did some TV ads, we did radio ads, we did brochures, we did websites, we did anything anyone would give us as work, we would do. And then after a year or so, we had to sit down and go, where do we focus? Where do we niche? And this opportunity came along with pitching. A few of our clients wanted us to help with their pitch, and we thought, we can do that. Why not? How hard can it be? And then over time, we kind of realized that it wasn't as easy as perhaps it seemed, and we started to really focus on what the nuances were of pitching for investment, and it became a specialty.
Yeah, I can really empathise with the nervousness around niching, because, in the early days, I can remember thinking to myself, well, there's loads of things I could do, I don't want to close off any of that. But, it's having the courage to niche and then kind of stick your flag in your particular little mountain and claim that for yourself, isn't it? Yeah,
it was a bit of an evolution. So we started then sort of saying we did both. We started actually, we created like an MVP, if you like. We created a one-page website on a different domain that was just sort of focused on the pitching for investment bit, once we realized that was possibly something that could be valuable to us as a niche, and sort of tested the market, went out and kind of pitched that and just sent people to that website, and but kept the other one going and sort of ran both side by side. Then realized that was a thing, we could make money out of this, and then merged the two together, and we're sort of had this sort of pitch, launch, grow. So we could pitch your idea, then we could help you launch your business and grow it with branding. And then we realized that actually we were getting such a good reputation for the thing that no one else did, that we became the industry leaders very quickly. We became the industry experts very quickly, and then we sort of ditched the branding after a few more years and just focused on this. So the most people think a niche or a pivot is you stop doing one thing and you do another. But when you think about the action of pivoting, if I was to ask you to pivot right now, you would keep one leg on the ground and you would move the other one. You need to keep that thing that you're doing that makes the money on the ground while you kind of pivot around. And then once that second leg is stable again, you can lift the other one off and carry on in that direction.
That's a really nice way to frame it. It's not like flicking a switch. It's not a binary thing, is it?
No. And I think a lot of people do think that, and that's why they're scared to niche. But actually, you can kind of niche over time, and as long as you do it in the right way, you can check that niche is going to work for you.
So can you give us a sense as to like how long you've been focusing on this particular market, and anything in terms of numbers, size, or something like that?
Well, like I said, Nick, my business partner, founded the company I think a decade or so ago. I joined 18 months later. Then it was probably a couple of years into it, we started focusing or sort of identifying the niche of pitching. And then it was probably 2 years after that we made the full switch. And it was 2020 that I launched the book. 2019, I started writing it. And that was really the launch of the book was the kind of trigger at which we said, right, we're now getting rid of all the brand stuff off the website. And it's just going to be about pitching for investment, and we've become a pitch agency instead of a brand agency. So full throttled focus on this and nothing else for about 4.5 years now. But doing it for sort of 8 years in total, and the business as a whole about 10 years. So.
Right. And anything around the sort of number of businesses that you've helped with achieve investment? Or well, we know, numbers, it'll be in the hundreds. I don't have the figure off the top of my head, but we know that our clients are 40 times more likely to raise capital as a result of working with us. They've raised more than 220 million to date. We've helped founders all over the world, UK, Europe, Middle East, Asia, Africa, Australia, literally have a global footprint now. So it's been great. I should probably know exactly how many customers, but it's in the hundreds. It's 10 years worth of customers. We're about to complete. We're at the end of we number all of our jobs, and we're at job number 960 something. So we're getting close to 1,000 projects, which is which is going to be a nice milestone to hit. Yeah, I mean, our listeners tune in because they know that we're all about looking at how best to implement strategy in a number of different scenarios, environments, organizations, so on and so forth. And obviously, with your, I think we can safely say, extensive experience now in this particular area, I think what's going to be really interesting to hear more about is what you've observed around founders as they've attempted to do that, and perhaps how they've evolved in doing that as they've progressed through, as maybe once they've received the investment. But before we dive into that, if I could start off drawing on that 900 plus like project experience, besides the obvious of having a killer idea or a killer product, what are the three things that makes a founder, and obviously the business, investable in your view?
Yeah, I'm glad you brought up killer idea, actually, because one of the key things I say in my book and in a lot of my presentations is that great ideas don't raise investment. Great communication does. And what you need to be able to do is articulate a business case around that idea that is going to make money and is going to scale and going to deliver investor returns. So yes, of course, you need a brilliant idea. I sort of, say that to deliberately kind of get a bit of attention, but you do need a good idea, but that idea needs to be in a large and scalable market. And there's really three things that founders need. And if we focus on those, it's you need to prepare that business case. You need the funding assets, the business plan, the projections, the pitch, and the communication tools to be able to go and sell those shares. So if we use that analogy we said earlier about all this is selling shares to a customer, which is the investor, and it's just a sales process. You need the collateral, right? You need the pitch, like you would pitch for any business. You need the sales brochure, which is the sort of the business plan and the financial projections that gives the full kind of detail behind what it is they're buying. And these business plan financials, pitch materials are really just sales collateral for making they're just your pitch and your sales brochure. The next thing you need is an investor network, right? In the same way as you have a sales cycle of you need to fill a funnel with leads, and then you need to nurture those leads, and then you need to convert those leads. The same is true when raising investment. And far too many founders get their pitch ready and go, right, let's go and raise. And it's like, oh, I haven't got a funnel. I don't have leads. I don't have, where do I find the investors? Yeah. So what you really need to be doing is you're thinking about raising investment, you need to start building your investor network now, have an investor outreach system where you can start to build and nurture relationships with investors. And once you get to know them, like them and trust them, or once they know, like and trust you, they then might purchase your shares. So you need to have you need to have that kind of mentality of, if I'm raising investment in the next 6, 12, 18 months, I need to start building that investor network now, bring them along the journey with me, keep giving them little insights as to my progress. So when I'm ready to ask them for their money, they already know, like, and trust me. And it's now just a commercial transaction. It's not a getting to know you from scratch. And then the third thing I think I'd say would be just your approach, your personality. You need relentlessness, right? You need to be it's tough. 1% of founders go on to secure funding. You need to be, if you get knocked down, get back up again. You're going to get more no's than you get yeses. You need to have that relentlessness if you're going to succeed as a founder. So there'd be the three sort of key areas I'd say you need to focus on.
I mean, you've described it, and it's really interesting because I've not really heard it sort of described like this before. But you've used the term purchase shares, which does rather kind of focus on it being, like you say, almost a sales transaction. And I think it's really interesting to frame investment as that, because usually I think investment is built up to be something much bigger than that. And I'm not saying I'm not saying that that's bad or good. I'm really intrigued by the kind of reframing that you're applying to it. Do you find that people respond to that more
absolutely
better? Do they find it less intimidating, perhaps?
Yeah,
or?
I think there's two reasons for it. One, there's, from a founder's perspective, the phrase they always use is, I need to raise investment. That means I need to give away shares.
Right.
You're not giving away shares. This is a transaction between two parties. It also starts to, when you then frame it as you're asking someone to purchase your shares, you then start to think about, okay, this is a high value transaction. So if I go into a shop and I want to buy a new TV, right? I'm only going to buy a TV that I think is of equal or greater value to the cash they're asking for. I'm not going to go and buy a TV that's more expensive than I think it's worth. Yeah. So if I feel like I'm getting a good deal, or if I think I'm getting a fair exchange, then then you'll make the sale, right? The shop will make the sale. And the same is true with it when you look at it through the eyes of an investor. You come along with your big idea and you say, I want 200 grand or $1 million to take that forward. Well, they'll only make that transaction if they feel what they're investing in is of equal or greater value to the 200 grand or the $1 million you're asking for. It needs to have, you need to then show, well, how do they get their returns? How do they get their money back? And they'll only do that if they believe your company can give them a 5, 10, 15, 20 times return on their investment in a few years' time. So it focuses the mind from away. It's not about my great idea. It's about the commercial transaction, and can the business sustain a return for the investor? Because that's what they're doing this for. So that's why I position it in that way, because it helps founders rethink the way that they consider this whole transaction, and that they need to present themselves in a way that makes 100K or 200K investment seem like a really good deal. You'd be stupid to turn it down. Not, right. Oh, this is a brilliant idea. Like, come and put some money into it. It's like, well, what do I get back? If I put 100K into your business, what do I get back? And what they want to get back is their shares being worth $1 million or more in 5 years' time, right? 10x my money in 5 years. So now we can focus our sales collateral, our pitch and our business plan and our projections on how do we deliver you that? If you invest in my business, how do we deliver that return? And it just, it reshapes it in a founder's mind, I think, as to what this whole raising investment thing is about.
Yeah, I think it's really powerful. I mean, I'm kind of going back to my old coaching days here, and sometimes just taking a concept which we all know and are very familiar with, and just using different words to describe it can shift the perception and the feeling and the whole emotion around it, can't it?
That's it. Absolutely.
Yeah, I think that's really, really interesting. The third thing on your list of 3 was around the sort of characteristics of the founder themselves. So you mentioned about them being relentless. For me, there's always a high degree of resilience in there. Like you said, get knocked down, get back up. When an investor is looking at a founder, what sort of evidence are they looking for to kind of prove to them that they have that resilience, that relentlessness?
Yeah. So when I talk about relentlessness, it's the relentlessness of the seeking investment. You have to, keep going. But yeah, investors are certainly looking for a founder with those traits, because business is tough, right? They need to, but they need to be adaptable. They need to be able to understand the market and adapt and change to that. So it's always good. This is part of the reason why it's good to build your network now if you're thinking about raising investment in 12 months, because you can drip feed them information. We've gone and tested this didn't work very well, but we learned from it, and now we've gone and done this, and that's worked much better. You can drip feed those stories into your network through your social media or through your email marketing, and you can bring these investors along on the process, and they can see they're dealing with someone who's relentless, who, when they take a knock, they see the positive in it and they find a way to overcome it and they get back up again. And so part of it's having a longer time to showcase your ability, because ultimately everyone can have a great idea. Anyone in the world can have a great idea, but only a small percent of people turn those ideas into a multi-million-dollar business. So they're not really looking for a great idea. They're looking for a great idea that comes packaged with a founder who can make it happen. So if you think about the top entrepreneurs or a founding team that can make it happen, you've got these big visionaries like Elon Musk, like Jeff Bezos, like Richard Branson. Richard Branson's a great example because he's a very much a doer, right? He was able to hustle Virgin into existence. It started in his, we all know the story, but he invited people over. He pretended he had this office in London, which he didn't have, and he just hustled his way to success. And you need to sort of show some of that kind of determination to get out there and get your feet dirty, run the streets, have that hustle, because you can't just rely on, I'm going to stick some money on some Facebook ads to get my business a success. You need to do the hard yards.
Yeah. And those that come to you, I assume their businesses are already up and running. They're trading. It's just that they want to take it up a gear. So that's why they're looking for investments. Is that
we
fair
have
to say?
We have 2 categories. One is pure startup, concept stage, looking for funding to get their proof of concept or minimum viable product built so they can go and test the market further. Yeah. So if you're in that position, there's some key things that investors would be looking for around traction and validation and market data. So both secondary market data and insights. Really want to invest in someone who has unique insights into the market in which they operate, but also that you've done surveys and focus groups and you can evidence that this is something the market wants and needs. Yeah. And then you have those that are more established. So they've got their first sales, they're already trading, and now they're looking for investment to scale up. And then the data, the information, the metrics that the investors are looking for more around customer acquisition cost and growth rates and all of the kind of financial data behind the existing trading company and what you've learned from it and how that can be used to have an effective growth strategy moving forward. So it sort of shifts, but they still all want evidence that this is something the market wants and needs.
Of course. Yeah. So those, I guess in particular, those that are already up and running and are looking to expand. So that second category, if you will. Once they've received investment, how do founders, or how much importance do founders place upon the founder's approach to leading the business, running the business, delivering results within the business? How much importance do they put on them evolving that? Because what worked when there was just maybe 1 or 2 of them is not going to work even when there's 10, 15, and definitely 20 of them. So what sort of level of importance to investors place upon that, looking for the evolution, if you will?
Yeah, absolutely. So they're gonna get a sense through their due diligence before they invest as to what kind of founder do we have here? Are they someone who we feel is capable of learning, evolving? How much support might they need from investors and advisors around being able to manage a team of 20 rather than just the co-founding team of 2 or 3 of you kind of hustling away at this? And do you have the capability and the skill set? They'll get a sense, a bit of a gut feeling on that. But they'll also, that comes across in the materials you produce, that preparation. If you've got a solid business plan, you've articulated in that business plan your reporting processes, your key kind of metrics which you are measuring to determine success. So then, when you've got a team of 20, it's still those things. If we want to grow this business, we need to achieve these key metrics, these key numbers. And if we don't, we're moving off target with those. We need to find a way to address that. So I think that's a really key area for any investor to understand that this founder knows. Again, it's taking it beyond that idea, right? It's not, I've got a great idea, I need some money to build it. It's like, we need to hit these sorts of numbers, these metrics, these key milestones. And this is our 30-day, 90-day, 1 year, 5 year, 10 year kind of goals. And we need to measure our success against those and make sure we stay on target. And if not, adjust those targets accordingly so that we can deliver you a return. So all of those clear, measurable goal setting targets that you would put into your growth plan are an indication that you're able to go and achieve those things, or at least know roughly what you're trying to get your team to do. It will be a learning curve for many because they've never been there. But that's where you look at founding team, right? So an investor's preference is to have a founding team. Their ultimate preference is to invest in someone who's always built, sold and exited a company before, because then it's like, they know what they're doing. But below that, it would be if you can evidence that you've been able to manage projects and deliver results within a corporate environment, and you're using those same skill sets into your business. So often when founders talk about themselves and their team, one, they don't talk about themselves enough. Like they're too shy. It's a British thing. Go to America and it's all about how amazing the founder is. In the UK, it's like we're too shy to kind of really tell everyone how awesome we are. But most founders make the mistake of kind of, this is my CV. I've worked for them. I've done this. I've done that. It's like, no, flip that on its head to, I delivered an X million project for company X. So how can you turn your experience in perhaps a corporate world into something that looks like entrepreneurial experience? So you have, I've managed a team of X people and we delivered Y metrics over an X year period, like rather than just, I'm X McKinsey or whatever. It's how do you articulate your CV in a way that actually is now saying, I can deliver stuff. Here's successes I've had. Here's results I've had. Here's how I've managed teams and built products or new services or created innovation within a corporate environment, whatever it may be. Just draw those little things out. That's what they care about. They don't care about the list of companies you've worked for. It's what you did at them. Yeah,
100%. 100%. I remember actually being given some guidance on CV writing many, many years ago, and they said it's not really important the positions, it's important, to list the achievements. All right,
that's
different context, but it's the same principle, isn't it?
Same principle.
Yeah, and something that jumped out right at the start of your answer there was the capacity to learn. And I suppose what comes with that is the capacity to or the ability to realize that you don't know it all, and that there is as a founder you are going to have to grow with the business if the business is also going to grow too. Is that fair to say?
Exactly. Yeah, and I think there's always a worry for founders, or an expectation that they need to have all the answers, and they're going to be under this scrutiny. They're going to be in that Dragon's Den environment, and they're going to be asked to explain themselves. And there's a tendency for founders to go, I don't really know the answers, so I'm gonna, and that makes me nervous. So what's going to happen is these investors are going to ask them a question, or they're going to challenge what they've said, what they've presented. How could you possibly achieve X amount of growth in Y years? And they're going to go, oh, sorry, well, what do you think's more realistic? Maybe we can adjust our financials to make them more suited to your expectations. And that sounds quite weak. It's not very attractive from an investment perspective. So you want to be able to back yourself, but do it in a way that you don't come across as a know-it-all. So it's like, look, we believe we can achieve this growth because of X, Y, and Z. Here's what company X did over here. Here's what company Y did over here. We've got a similar business model to them. And if they're able to achieve it, we believe we can too, given the size of the market and opportunity, and you justify it. However, we know that's a really ambitious target, and we're going to have to really perform, in this way. And we're going to perhaps even need a little bit of luck, but we want to bring on board investors and advisors around us who can support us in this journey so we can collaborate together. And you just sort of show your ability to want to learn and develop and grow while backing yourself and not just going, oh, I've got it wrong. What do you want to see? So it's a delicate balancing act between showing your capability to want to learn, evolve, and bring in on board other advice, but also having the confidence to back yourself without coming across as arrogant. So it's a really difficult balancing act, but you somehow need to kind of weave the two together when talking to investors. So so you're attractive as a proposition, I suppose.
I mean, going back to the early years of my business, I was doing a lot of work with founders here in the startup sector, tech sector here in Manchester. And you could always spot the ones that you knew were going to go far because they did have that balance. They had the confidence, they had the belief, perhaps, in what it was that they were trying to do, but they also accepted. They kind of kept the ego in check as well at the same time, and they knew that there was more that they needed to learn to take it forward to get it to the next level. And I just to flip that, I did see a number of particularly it tended to be once they'd received their first round of investment who kind of got to a point where they didn't want to let go of control anymore. And it was the control aspect that was holding them back. And the founder was becoming the bottleneck to the business. I mean, the typical example, I suppose, is in decision making. They've been so used to making all the decisions. There needs to come a point where they have to let go of some of that and start to empower those that are working with them. Because if they don't, then those people are not going to stick around. They're just going to walk. And they weren't there from the beginning, so they don't necessarily have the passion that the founders have. So the big challenge for the founders in that situation is to start to show some real leadership and instill some of that fire in those new recruits that they've had since the start.
It's so tough to let go, I think, as a founder, because it's your baby, right? The analogy I use, because there's the other fear from founders when they bring on board investment is, one, losing that control, but two, being kicked out of the company by investors because they've heard those stories. And I think the way I like to, or even exiting the company, but the way I like to think about it is everyone refers to their business idea as their baby. Quite often, it's often referred to as like, this is your baby. You struggle to let go. Well, if we take that analogy further, at some point that baby becomes a teenager, and you're like, get out of my house. When are you turning 18? When are you going off to university? When are you getting your own space? And at some point as a parent, you want to have educated and grown this baby into a child and into a teenager and into a young adult who can then go off and spread their wings and do their own thing and make their own impact on the world. And if you follow that analogy through with your business of, yes, the business is my baby, every founder ends up more or less in a position where at some point it becomes a teenager or a young adult and they feel like it's time to let it go. I've taken it as far as I can. And now it's for someone who, I don't want to be the CEO of a 200 people organization. I like building things with teams of 5 to 10 people. So I'm happy at some point, if you are successful, you want to take that step back and let someone else come in as CEO and take it forward. And maybe you sit on the board as chairperson, or maybe eventually you completely leave. And we saw that happen with the founder of Monzo, right? He built a challenger bank, was super passionate about it. It got too big. He lost all kind of joy from his role. He went to the chairman of the board, brought in a new C-suite team, and sat there for 12 to 18 months and then realized he really didn't even want to do that. And I think he's left as chairman now and just focusing on his new startups. And he wants, most founders are innovators. They love to build stuff. They don't want to be managing a corporate. And if you're successful, you get there and you find that actually, even though right now you're going, oh, I don't like the idea of losing control or being kicked out of the business or having to sell it to someone else because it's my baby, you'll probably get to the point where you actually feel in 5, 6, 7 years time that now's the time for me to hand this over to the person who can take it forward and let it spread its wings and achieve what it can achieve more without me than with me. So having that understanding, that's the other thing an investor's sort of looking for. Kind of, it's not something you can really put in a pitch, but it comes across in the way you present and the way you talk with investors that you realize that that's probably going to happen. You're not holding on to this and you don't want to not exit it. You want to stay involved forever. You want to show that this is just the start. We're getting it to this point and then we want to sell it perhaps and someone else can take it on the next leg of its journey. And that shows a lot about kind of your makeup as an individual as well.
Yeah. I love the analogy of, going through the different stages of growth with a child, a teenager, adult. I think that frames it really nicely. And I guess, what we're talking about there is business maturity to a certain extent. And particularly if you've got investment that's enabling that maturity to happen, there's going to be a greater level of scrutiny than perhaps they've been used to in the past, them being the founders. So how do you find that the founders tend to respond to that? They're getting put under the microscope for what they're doing and getting probably measured a lot more than they were previously. How do you find that they respond to that generally?
Again, I think it depends on the founder, but the best founders, the founders that succeed, realize that ultimately everyone involved that they bring into the business all want the same thing, right? They all want the business to be successful. The investors want it to be successful so they can deliver a return on their investment. The founder wants it successful because they have a passion for it and they want it they want to have that success story. So it's making sure that you set clear boundaries with, I think, the investors as to what you're going to report, how often you're going to report to them, when the time is to have the right conversation. Because the last thing you want as a founder is to have an investor on the phone every week. How's it going? And that comes to doing your due diligence on the investor and kind of going, they're putting 50K into my business, but is that their whole life savings? Because if it is, they're going to be really worried about how that money's performing. Whereas if that 50K is part of $1 million they have to invest, then they're barely even going to remember they even invested in you. And you'll probably never hear from them. And you'll be emailing them the reports and they'll be going, who are you? What? Yeah. And you're like, you've invested in me. So it's all contextual to kind of how much that investment is worth to them personally as to how involved they often want to be. But some love to do it. Some are just buying they're exited founders or they've been in the corporate world and they're coming to the end of their career and they just like the idea of being part of something. Yeah. That they and they're buying a ticket to be a Ned and they're, I want to be an advisor. I want to be part of this. I've got loads of experience I can offer. And look, if it's successful, I want to get a return. So I'm going to buy my way into this exciting opportunity and offer my services as an advisor in return for investment and some equity. Mm-hmm. And they're actually just buying themselves. So they want to be quite highly active and you have to be sure that they're going to be part of the team. And therefore you need to think about bringing on that investment, not just for the money, but do they fit the right culture and the team and they're the right person you want around you quite regularly. So it all depends on the type of investor. When you go to move to VCs, they're going to want quite, they've got to report to their investors, the insurance companies and the hedge funds and the pension funds that have put capital into their funds. So they're going to need certain information and you need to just agree what you're reporting, how often you're reporting it, and give investors a space to have input in the business. But you also need to be mindful of the amount of control you give them in the shareholders agreement as to what you can and can't do without their say so and all of those sorts of things. And that will be deal to deal.
So you mentioned VCs there. Am I right in thinking that VCs are not where you guys come in? They're a bit later in the process if they're going for further investment. Is that fair to say?
Yeah, so some of our clients are in the position where they're pitching for VC investment as opposed to angel. So it really depends. We work with clients in the sort of first, second, and third round of investment. So those in the second and third round of investment start to be in the position to talk to VC. So the early stage VCs will invest at concept stage as long as there's a considerable amount of validation around it. Perhaps you already have users or you already have customers. But you're very, maybe only making a few grand a month. That's where the earliest a VC is likely to get into, but they're doing it as an SEIS fund. They're getting some tax benefit for doing so. Yeah. But most VCs want to be seeing sort of $1 million in revenue or more, sort of recurring revenue before they get involved. So you tend to be at that level before you start talking to VCs.
Right. And I don't know whether this applies more to VCs rather than perhaps angel investors, but how important is it for the investors to have like a common framework that they use to track the performance of all those that they invest in? Because I'm sure they wouldn't want to be, reinventing the wheel each time they take on an investment. There's got to be a degree of, I hate this term because it's a really corporate term, but I'm going to use it anyway, a degree of governance around it. Obviously it's easy to track the numbers because the numbers are there on paper or, in Xero or whatever. But I'm also if I could expand the question to include perhaps the non-financials, which are also important, but sometimes don't necessarily get the same focus as the financial measures. Yeah,
I think the VCs are going to be much more rigid with that because, but equally angels too, if they're sort of quote unquote professional angels that kind of do this regularly, as opposed to a high net worth business leader that's got a couple of investments here and there, they're probably a bit more go with the flow. It'll be different but if you've got a portfolio of 20 or 30 individuals, you probably you're gonna want to track those somehow, and equally the same for a VC. So the difficulty comes, of course, when you raise a round and you've got multiple investors. So you've got 2 or 3 VCs perhaps making up the round, one lead VC and then some follow-on VCs, and making sure that they all get what they need from what you report, and also making sure that you're able to turn around to them and say, this is great, I'd love to provide you all this information every week or every month or whatever, but I do need to build the business and kind of deliver your return. So there's got to be a balancing act between how much you report and how frequently you report, and you don't want to bring in investors that are hindering your progress. Yes, you want their money and they want to make sure their money's being spent well, but there needs to be that balance between what they're asking for and what you're able to deliver so that you can actually implement stuff rather than constantly report to them. So it's getting that balancing act, but most will guide you, right? We're talking here with founders who are doing their first, second round. By the time you get to your third, you've kind of got some systems up and running. So investors will probably just sort of follow on with that. But first and second round, investors who are investing in founders at that stage know that they've never done this before. And there's this expectation from founders that they need to know how all this stuff works. That's part of the learning process. And investors know that. You've never done this before. You've never had to, it's not unusual for an angel investor to kind of guide the founder through that. Okay, now you need to go and talk to your accountant and get the heads of terms drawn up, or now you need to go and we need a shareholders agreement now. Oh, okay, because you've never done it before, right? So and they know that because they spend their days investing in early stage companies in their first round of investment. So if they're going to be part of the team and they're going to bring on board money and they're going to be an advisor or they're going to sit on the board and you're going to have to report to them every quarter, leverage their experience and say, right, look, you want to invest in this company, that's great, we've got kind of a deal agreed in principle. What do we do next? Sorry, I've never done this before. And they'll go, you don't have to know it all. You should have a relationship with that individual by then to be able to have that conversation with them. So they'll tell you what they want and the best way to do it. And then if you feel that's reasonable and perhaps you chat with some external advisors to make sure they're not asking you to do things that are unreasonable, you should find yourself in an okay position.
So I'm from what we've talked about so far, I'm kind of getting this sense that it is, I'm putting my strategy execution hat on, strategy alignment hat on, and when there's a group of 2 or 3, it's not that. I mean, have clear goals, but that's probably about as far as you need to go. As you get bigger, more complex, more people, more teams, it becomes a bit more. It demands a bit more focus.
Absolutely,
as things don't just naturally happen like they might have done when there was 2 or 3 of them. And what I'm hearing is that in many respects, the investors are almost there to either provide that advice or provide resource that can give that guidance on the maturity. Again, moving from child to teenager, and one of the measures of maturity might be around how much do they focus on getting, the delivery of an achievement against the targets that they set themselves. They don't just set the target and expect it to happen.
Yeah. I think if we keep this child analogy on, I guess you could look at the investor as the kind of the teacher or the childminder. So they've already had cohorts of these babies come through. Yeah. They've already seen someone develop from 0 to 6 years old, and they know whether or not your child is behind in their speech development or should be going to the toilet by themselves by now. And they can have a word in your ear and say, "I think you might need to go to the doctor, talk to a doctor or a health clinician because he's a little bit behind on his speech to some of his friends." And that's what. And that's kind of, if you think about the investor, unless you happen to be their first investment they've ever made, and then you're going to just figure this out together. But most of them, certainly when it comes to kind of a more professional investor or VC, you're going to be their 5th, 6th, 10th. They've probably already lost a load of money on ones that didn't work, and they've figured out what they should have done differently as an investor to make that more successful. So they've been through this, and they're on a learning journey themselves, from their first investment to their 10th investment to their 50th investment, as to what they should do and how they can best work with and manage the founders that they're working with. So it should be seen as a collaborative thing. And that's something I talk about, is kind of seeing yourself on an equal with the investor. You are 2 people heading towards the same thing. You both want something similar, and you're working together to make it happen, not putting the investor on this pedestal as this kind of godlike creature that knows everything about what you should be doing, and you should fear them, and fear their wrath. It's kind of, this is a collaboration. You're getting into, you're getting into a relationship together that's going to last 5 years or more as you look to grow and exit this company if you're successful. So you need to have that kind of, make sure that you have that relationship with the investors that you bring on, or if they're not, or they're very passive and there's someone who just they just want to give you money and leave you to get on with it, and that's fine. But if they're going to be in any way active in the business, you want to make sure you can have that relationship with them, because this is a long-term thing. This isn't a short-term, we've done a deal and we got your money. They're still a shareholder in 10 years' time, potentially. So, you got to think about it in those terms.
Yeah. I you mentioned intimidation there. I wonder just how much damage Dragon's Den has done to the whole reputation of investors. That's done for television, and it's the competitive arena situation that they set up. But what you don't then see is how they then work with the investments that they've made. And I'm sure they are really supportive, because it's in their interest to be supportive. But you just don't see that, because that's not good for television.
No, and you see them and their team. And you also don't see the 90% of the deals that are done in the Den don't go through in reality because of due diligence, because all the things we mentioned earlier don't play out. They pitched really well and they said, I'll invest. But then there's the whole due diligence, the conversation, the business plan, the financials, the reporting, all of that stuff. And if you can't deliver that to them, so 90% of the deals in the Den don't go through. And Deborah Meaden and Peter Jones have a lot to answer for. But it's quite funny. I was talking to an investor at an event, and this sort of thing came up about something I'd said at this talk, and they were like, you make it seem like these founders are scared of us. And I was like, well, they are. And they're like, why? We just want them to succeed. I was like, because of Dragon's Den, they think you're Deborah Meaden. And this female investor was like, oh, I get it now. Yeah, I've never looked at it through the founder's eyes before. Of like, they're intimidated coming to us because all their only reference point is Dragon's Den, Shark Tank, and The Apprentice, where they just basically destroy you live on TV, right? So that's the context that everyone has when going to investment, and the investors can do a lot. We talk a lot about founders understanding the mind of investors and communicating to them in a way that makes them want to buy their shares, but investors could do a lot for understanding the perspective of a founder coming to them for the first time and this being a big deal. They've never done anything like this before. They don't know what they're doing. They're outside of their comfort zone. And if they can get into the mind of a founder and that position, I think that everyone would get on much better and it would be much easier to do this.
Yeah. So, okay, let's work on kind of wrapping things up, because I don't want to take up any more of your time, but what you've shared has been really, really insightful. So thank you, James. But let's just leave with perhaps the cherry on top of the cake. So what's the one piece of advice you would give to a founder that was thinking about seeking investment?
Plan and prepare and do it earlier than you think.
Right.
I think most founders leave things too late, far too late, and then they're in a rush and then they look desperate. And no one wants to invest in someone who's desperate for cash. They want to invest in someone who's making moves. They've got momentum behind them, and they want to be part of that journey, and they want to jump on board. So the way I like to think about it is that you have two train tracks. So most founders think that they're on a journey. They're on a single journey, going from station to station, stop to stop on this business development train. And they're going to get to a certain point in their business development, and then they're going to need some funding. And then they're going to go from stop 2 to 3 is going to be the investment journey of their business development. But actually, there's 2 train tracks. One's business development, and the other is fundraising. And your job as a founder is to get investors on the investment train as soon as possible, so they can ride that train in parallel to you on a second track, looking out the window going, wow, look at what they're doing. This is awesome. They're so exciting. They're innovative. They're moving forward. So when you come to the point of asking for their money and needing to go on that investment leg of your journey, you already have a full train of people who have seen you progress, who are ready to support you when you want support. And then you say, I'm raising investment, and they all jump on board your train and they carry on going. And you need to have that kind of dual. If you think you might be raising investment at some point in the future, you should have this dual strategy of, I need to focus on building the business and I need to push that. But on the side, I need to start building my network and taking industry leaders and experts and wealthy individuals and investors along on this journey with me, and talk about the highs and the lows. We've tried this and failed. We've achieved this result. We've just had this great partnership opportunity. Just tease people with your progress. And then when you want the money, that money becomes much easier. So you kind of need to prepare much sooner than you think in most cases. So and when you do that, warm them up, nurture them like any sales cycle. If you think of this as a B2B sales campaign, if we finish where we started, right? Yeah. Any good B2B sales campaign will know that if you're doing a corporate deal, if you're trying to sell a corporate software into a big corporate, you need at least 6 to 12 months sales cycle from initial lead to close, right? But I think most founders think this investment thing is like an e-commerce transaction where you just show someone your pitch and then they pay you the money. So it's a B2B sales cycle of a 6 to 12 month nurturing period of kind of giving them all the information before that cash lands in your bank. And the sooner you can start building those relationships and filling that funnel. We've got people who signed up with us this month who first came into contact with Robot Mascot 4 years ago, right? Right. Every business has has a sales cycle, and people need to know, like, and trust you. So the sooner you can get started on the journey, the more likely you are to close. And you often hear, we've got a few success stories where we're like, they closed their round in a week. They launched their round and they closed it in a week. The reality is they were building that network for about 12, 18 months before they launched their round. So the headline is they closed their round in the week. The reality is they pre-built a network for 12 to 18 months prior to that, ready for that to happen. And they're the founders who get the money quickly, in essence, because they've actually spent their time preparing beforehand. That makes a lot of sense. So if
any of the listeners want to reach out to you, get in touch, how can they do that, James?
Yeah, well, connect with me on LinkedIn, James Church on LinkedIn. You can go to the Robot Mascot website, robotmascot.co.uk. From there, there's loads of free resources. You can get a copy of my book for free. You can take a scorecard to test your eligibility for raising investments. So you could join some workshops. So there's loads of free resources on there. So just head to the Robot Mascot website and you've got everything you need to get started.
Fantastic. And the book is, what's the title of the book?
The book is called Investable Entrepreneur. So if you fancy getting it on Amazon or any good bookstore, you can buy it, but it's free on the website. So why would you bother?
And we'll put all the links in the show notes. So listeners, just have a look in the show notes and you'll be able to find them just there. James, thank you so much for your time and your insights and your experience today. I know I found it really useful, and I'm sure our listeners have as well. So thank you very much again. And thank you to you listeners for joining us for yet another episode of Giant Talk. And you can rest assured I shall be back again very soon with the next one. Take care now.